Business and finance professionals frequently confuse and use the phrases merger and acquisition interchangeably. On the appearance, the difference may not seem significant because the end effect is typically the same. Two or more firms with different ownerships are now working under the same roof, generally to achieve some strategy or financial goal. However, depending on the how transaction is structured, the strategic, financial, tax, and even cultural implication of the sale might be different. Merger refers to the uniting of two companies, generally by the exchange of the share to form a single entity. An acquisition happens when one company, the buyer, pays cash, stock, or other valuable assets to another company, the seller, in trade for the seller's asset or shares. For example, the merger and acquisition market in Malaysia has slowed substantially in recent years, with the number of complete mergers and acquisitions in Malaysia involving publicly traded firms decreasing from 338 in 2013 to only 78 in 2017. Because of that, the consumer and finance sector accounted for 55% of Malaysian merger and acquisition from 2012 to 2015. The reported transaction value in Malaysia for real estate merger and acquisition was 14 billion ringgit, accounting for 88% of the transacted value in the financial sector in 2015. Alright, a merger is the combining of two companies into one, either by closing the old businesses and forming a new one, or by one company absorbing the other. To put in another way, two or more companies are combined into one. However, a merger is not the always best strategy to enhance management. It is often the only easy and realistic choice. Managers are naturally reluctant to terminate or demote themselves. An investor in a large public company have a direct say in how they are managed. There are a lot of reasons why two businesses choose to be one or to combine. It's done out of convenience at times, and it's done out of the need at other times. Regardless of nuance, the aim of a merger is to focus on strategic gains and the favor both companies. A merger benefits its profits could be increased, expertise can be enhanced, market share can be expanded, and products can be diversified. The purchase of one company by another is known as takeover or acquisition. The buyer is referred to as the bidder or acquirer, and the company it wishes to acquire is referred to as the target. It's a merger, but it's not one of equals. There is predator and prey in the case of acquisition. There have a few types of takeover. Firstly, a friendly takeover occurs when a bidding firm approaches a company's management board with an offer for the target company. If the board decides that the takeover offers potential benefit to shareholders, they will encourage shareholders to take advantage of it. Secondly, when the target company's management board refuses a takeover offer, but the acquiring company pursues it anyway, this is known as a hostile takeover. For example, persuade the majority of shareholders to sell directly to them in order to gain control of the company. Firms will sometimes acquire a growing number of shares on the open market in order to gain more control of the company through stealth. Thirdly, the conglomerate takeover can be described as when a firm buys out another firm in other industry. For example, Google buy out ITV Neo. And the last one, a reverse takeover. A reverse takeover is a private corporation purchase a publicly traded company. It is known as a reverse takeover. In reality, it is a viable method for a private business to float. In other words, it can go public without acquiring the cost and time associated with an IPO. An acquisition is a business transaction in which one company buys all or part of another company's stock or properties. Acquisitions are commonly made to gain ownership of and expand on the target company's asset while also capturing synergies. The acquiring company purchases the target company's stock or properties giving it the authority to make decisions about the acquired assets without seeking approval from the target company's shareholders. The acquisition helps in the identification of a new industry, consumer base, and the synergy benefits. It will not only give a company an advantage, but it will also add maturity to the firm's operation. As a result, acquisitions are regarded as the first step toward achieving market leadership. There have a few types of acquisition. Firstly, horizontal acquisition. Competition is the most important thing to consider when creating every business formula in the market. If the company wants to succeed in the market, it must actively aim to increase its market share. In the industry, a competitor is an organization that is growing at the same stage of development capacity and serving the same class of customers. For example, is Facebook acquisition of WhatsApp. WhatsApp's brand name is still in use, but it is now owned by Facebook. We will go into more detail about this transaction in the AIM classification of acquisition. While Facebook and WhatsApp are both in the same field, that of social media, the merger has ended in the both companies benefiting from expertise of the other. The second one is when a company buys another company in particular section of the supply chain of the goods or services they offer. This is known as vertical acquisition. This is just another creative way for businesses to increase their productivity. For example, textile company could purchase cotton from a farm. This is primarily done to gain huge control over the supply chain, which has an effect on the receipt of raw materials and product distribution, as well as the time it takes to source, input, and deliver the product to the end user. In the conglomerate acquisition, a purchasing company aims to get ownership of a target company in a separate market, resulting in the formation of the conglomerate. In order to diversify risk, parent companies can purchase several smaller businesses. Acquired businesses can continue to operate independently, but the parent company reaps the benefits of reduced exposure and therefore risk in any given market or industry. The last one is conjoint acquisition. A conjoint acquisition occurs when the two companies that perform separate but similar roles for the same customer base join forces. A bank purchasing a niche financial services business, such as an insurance agency or a loan provider, is an example of the type of acquisition. The acquiring company, in this case the bank, will incorporate the target firm product line and customer base into their own, as well as cross-sell their own goods. A defensive purchase is a corporate finance strategy in which businesses buy other companies and assets to protect themselves from market downturns or potential takeovers. A defensive acquisition changes from the typical motivation for the purchase, which is typically increased market share or sales. Firstly, divestiture. A firm sells asset or division to the highest bidder on the sales. It receives cash which is reinvested in the new assets or returned to the stockholder as dividend or go for stock buybacks. Spin-offs. A firm separates out asset or division and creates new shares with the claims on this portion of the business. The third one, split-ups. Split-up is similar to spin-off as it creates new shares in the undervalued business line. In this case, Golden Parachutes target firm make large payments to the managers of firm if it is acquired, which will lead to cash drain from these payments. It will render the acquisition or merger infeasible, which is if acquirer will leave the acquirer with huge debt level. In a poison pill, which occurs generally really do among committing economic suicide to avoid a takeover. As such tactic as borrowing on terms that require immediate repayment of all loan if firm is acquired. In a wise acquirer, an individual or company who is friendly to the current management is asked to buy enough of the target firm shares to buy a hostile takeover, making it almost impossible for the acquirer. Thank you for today. Alright, that's all for today. Thank you.